Let me say this straight. No dramatic music, no hype voice. AI is real. AI is powerful. And yeah, parts of it are absolutely in a bubble. If that sentence already made you uncomfortable, good. That's the point. Because every time something truly game-changing shows up, money moves faster than logic. Logic. And right now, logic is jogging. Money is sprinting. I've seen this before. Maybe you have too. Crypto. NFTs.com stocks. Different tech, same human behavior. And this video isn't about trashing AI. I use it. You're watching this because of it. It's not going away. This is about how people lose money when they confuse the future with a price doesn't matter. The hook, real talk. A few months ago, someone messaged me and said, Bro, I just put my savings into an AI startup. They don't make money yet, but it's AI, so it's guaranteed. That sentence right there. That's how bubbles talk. Not with numbers, with certainty. When people stop asking, how does this make money? And start saying it doesn't matter, it's the future. You're officially in dangerous territory. Here's what's actually happening. AI is doing two things at the same time. It's creating real value, it's attracting lazy money. Those two always collide. You've got companies genuinely saving time, cutting costs, replacing entire workflows. That's real. And then you've got companies adding E to their pitch deck, like it's a magic spell. A same revenue, same product, same problems, new label, higher valuation. That's not innovation, that's marketing. The dot-com parallel without the boring history lesson. Back in the late 90s, the internet didn't fail. The pricing failed. Amazon survived. Pets.com didn't. Why? One had a business model. The other had a Super Bowl ad. Most people remember the crash in Thinkicy? Tech was fake. No, the tech was early. The expectations were insane. AI feels exactly like that moment. Where people are going to get hurt, let me be very clear here. People won't lose money because AI is useless. They'll lose money because they bought hype instead of cash flow. They assumed growth replaces profits. They invested at prices that required perfection. If a company needs everything to go right just to justify today's valuation, that's not investing. That's hoping. Hope is not a strategy. It's a feeling, and markets don't care how you feel. What smart money is quietly doing this part matters. Smart money isn't asking, is this AI? They're asking, does this reduce labor costs? Does this increase margins? Does this lock in customers? Does this scale without burning cash? Posts. They're buying boring companies using AI, not flashy companies selling dreams. Think infrastructure. Think picks and shovels. Think companies that sell tools, not stories. No one brags about those at dinner parties, but that's where money compounds. What I'm personally doing, no guru stuff. I'm not trying to pick the next AI rocket ship. I'm doing 3 boring things. Staying diversified. If one theme can wipe you out, you're overexposed. Following cash, not headlines, revenue first. Profits eventually. Promises last. Keeping dry powder because bubbles don't pop quietly. They create discounts. The real money isn't made at the top. It's made when fear shows up and quality goes on sale. What happens next? The part no one likes. Here's the honest timeline most people won't say out loud. AI keeps growing, expectations get stupid, weak companies fail, strong companies survive, prices reset, long-term winners emerge. That's not bearish. That's how progress works. The bubble popping doesn't kill AI. It clears the room. Final thought, listen closely. If you remember one thing from this video, make it this. Being early doesn't matter if you overpay. The future can be real, and the investment can still be bad. Wealth isn't built by predicting the next big thing. It's built by staying rational while everyone else is drunk on excitement. Amazon didn't win because it was online. It won because it executed relentlessly and grew into its valuation. Most AI companies won't get that chance. Why prices fall even when progress continues? Here's a brutal truth. A company can improve every year, and the stock can still go down. Why? Because expectations were too high at the start. If investors expect 100% growth and get 40%, that's not failure. But the price will act like it is. That's what happens when prices run ahead of reality. What this means for you, practical, not preaky, this doesn't mean avoid AI. It means Be skeptical of certainty, separate product quality from investment quality, respect price as much as potential, ask boring questions. Who pays? How often? What's the margin? What happens in a downturn? If those answers are vague, your risk is high, no matter how exciting the demo is. Final reality check AI will absolutely reshape the economy, but reshaping the economy doesn't guarantee reshaping your net worth if you buy at the wrong price. History is full of people who were right about the future and still lost money. The winners aren't the loudest believers. They're the ones who stayed disciplined when everyone else was shouting. This time is different, because it never is. Not when it comes to human behavior and money. And that's the real risk hiding inside the AI boom. But here's the part most people get wrong about bubbles. They think bubbles burst because the technology turns out to be useless. That's almost never what happens. Bubbles pop because expectations get too high to survive reality. AI could keep getting better every single year, and a lot of AI investments could still crash. Those two things are not opposites. They can happen at the same time, and that's what confuses people. Progress and price are two different things. Technology moves forward in a straight line. Markets don't. Markets move on emotion, hope, fear, excitement, disappointment. When expectations get stretched too far into the future, price becomes fragile. All it takes is one earnings report that says growth slowed a little, costs were higher than expected, adoption took longer, and suddenly the story cracks. Nothing broke. Reality just showed up. Why a great news it can still tank a stock. This is the part that feels unfair. A company can beat revenue, show strong user growth, launch impressive features, and the stock still drops. Why? Because investors weren't buying results. They were buying perfection. When the market prices in the best possible future, anything less feels like failure. That's how expectation bubbles work. AI is especially vulnerable to this. AI sits at the intersection of cutting-edge tech, massive promises, unclear timelines. No one really knows how fast adoption will happen, who will dominate, how regulation will land, so markets fill in the gaps with optimism. And optimism inflates expectations faster than reality can catch up. What actually triggers the ebb bubbles don't usually explode in one dramatic moment. They deflate. A few disappointments, a few missed timelines, a few earnings calls where management sounds less confident. Confidence, money quietly leaves, prices slide. By the time headlines scream a crash, most of the damage is already done. The important takeaway: when expectations reset, it doesn't mean the tech failed. It means price was wrong. And understanding that difference keeps you from panicking at the wrong time or buying at the worst one. Because the real opportunities don't show up when expectations are sky high. They show up after they break. This is the quiet killer. Not bad luck. Not bad timing. Bad assumptions. People don't usually lose money because they were reckless. They lose money because they believed something too strongly. Because while others are jumping from story to story, smart money is getting paid. Final reality check: if your investment needs constant excitement to stay attractive, it's fragile. Cash flow doesn't care about narratives. It doesn't care about trends. It doesn't care about trend cycles. It just works. And in the long run, that's what builds real wealth. Not being right about the future, but getting paid while you wait. Let me start with a hard truth most people don't want to hear. Money is not lost or made because of intelligence. It's lost or made because of behavior. Some of the smartest people in the world blow up their finances. Some very average people quietly become wealthy. The difference isn't IQ, it's emotional control. And nowhere is that more obvious than during hype cycles and crashes, like the one AI is slowly setting up. Markets don't reward being right. They reward being calm. Here's something that sounds obvious, but is rarely practiced. You can be right about the future and still lose money if you panic, chase, or overreact. Now, markets are designed to mess with your emotions. When prices are going up, you feel smart, you feel late, you feel pressure to do something. Prices are going down, you feel stupid, you feel scared, you feel like you need to get out. Notice the pattern? Your brain wants action at exactly the wrong moments. Why excitement is more dangerous than fear most people think. Fear is the enemy. It's not. Excitement is. Excitement makes you ignore valuation, ignore risk, ignore history, ignore position sizing. Excitement convinces you that this time is different. That phrase alone has destroyed more wealth than recessions ever have. When everyone is excited, prices already reflect that excitement. There's no margin for error left. You're not buying opportunity, you're buying expectations. The crowd is almost always late. Here's a pattern that repeats over and over. A new technology emerges, early builders struggle, quietly success becomes visible, media attention explodes, retail money floods in, prices peak, reality sets in, most people show up at step 5. Not because they're dumb, but because that's when it feels safe. Everyone's talking about it. Everyone's making money. Everyone says you're crazy if you don't buy. That's usually the worst time. Why crashes feel personal, but aren't. When markets drop, it feels like you made a mistake, you missed something, you failed. But markets don't care about you. They don't know you exist. A crash isn't punishment. It's for pricing. Prices don't fall because you were wrong. They fall because expectations were too high. Once you understand that, panic loses its power. The moment wealth is actually created, this is important, so read it slowly. Wealth is not created when you buy. It's created by the price you pay. The biggest opportunities don't look exciting in the moment. They look uncomfortable. They show up when headlines are negative, confidence is gone, people are embarrassed to talk about the investment. That's when prices offer margin of safety. That's when rational thinking pays. Why most people can't act when opportunity appears. Here's the cruel irony. When prices are high, buying feels easy. When prices are low, buying feels terrifying. Your brain is wired for survival, not investing. Fear tells you, oh, what if it goes lower? Oh, what if I'm wrong? Oh, what if this time it really is broken? That fear is strongest exactly when opportunity is largest. That's why discipline matters more than courage. Rational doesn't mean fearless. Being rational doesn't mean you don't feel emotion. It means you don't let emotion make decisions for you. Smart investors still feel doubt, fear, uncertainty. They just don't obey it. They rely on process, rules, position, sizing, time horizons. Emotion is temporary. Process is permanent. Why cash is a weapon, not a waste during hype cycles. People hate holding cash. They say things like, a cash is trash, you're missing out. A time in the market beats timing the market. Those phrases are half truths. Cash isn't for returns. Cash is for optionality. It gives you the ability to act when others can't. When markets fall, cash buyers become price setters. That's power. The patience advantage no one talks about. Most people underestimate how powerful patience is. They think wealth is built by constant action, frequent trades, always being invested in reality. Wealth is often built by waiting, observing, acting rarely, but decisively doing nothing is emotionally hard. That's why it works. AI, fear, and the next opportunity when the AI hype cools. Not if, when the narrative will flip. You'll hear AI is overrated, or it was all hypey, regulation killed it. A growth is slowing. That's when real analysis matters. Some companies will deserve to die. Others will be mispriced. Your job isn't to predict which is which today. Your job is to be emotionally ready when that moment arrives. How to stay rational, practical rules. Here are a few grounding rules smart money lives by. Never go all in on a theme. If one idea can ruin you, you're gambling. You're gambling. Assume you're wrong. Build from there. Ask what happens if your thesis fails. Size position so you can sleep. Stress is a signal you're overexposed. Separate news from noise. Headlines are designed to trigger emotion, not inform. Play long games. Time is the only unfair advantage available to normal people. The emotional cycle that repeats forever, every bubble follows the same emotional arc. Optimism, excitement, euphoria, anxiety, denial, fear, capitulation, opportunity. Most people enter at excitement and exit at fear. Wealth is built by doing the opposite. The final truth about money rewards the boring traits. Patience, discipline, humility, emotional control, not brilliance, not confidence, not bold predictions. If you can stay rational while others are emotional, you don't need to be a genius. You just need to survive long enough for compounding to do its job. Final thought, this is the real edge. You don't need to predict the next crash. You don't need to time the exact bottom. You don't need to be early. You need to be ready. Ready with capital. Ready with discipline. Ready with emotional control. Because the biggest money isn't made when everyone agrees. It's made when clarity returns and most people are still too emotional to act. That's how real wealth is built.